Before we even try to understand on how to invest your money, it is really important to understand why you need to start investing. If you have studied basic economics, then you will understand that money loses its value over time due to inflation. Did you know the things that you were able to buy for $1 in 1950 would cost you $11.67 in 2022? In other words, a dollar in 1950 is now worth 8 cents in 2022. For example, if you would have stashed $1,000 under your pillow in 2010, then in 2020 it would have been worth $763.07, as inflation would have robbed your savings due to rising prices of goods and services. So the value of your money would have fallen, which is not good. Even if you put your money in savings account, which gives you an interest rate of 0.1 to 0.2% on the cash in your bank, you will still keep on losing money, as average inflation is around 2 to 3%. But as per recent CPI data, the inflation is at peak compared to the last 40 years at over 7%. So the value of your cash is losing even faster in 2022. So the question here is, how do we stop losing money over time, and how do we also make money in these circumstances? Hey everyone, it's Nikhil Moore here, your frugal investor, and welcome to my channel. Okay, let's imagine there was a bank that would pay you 10% interest on the cash you have in your savings account. In that case, you will not only beat inflation but will also make good money year over year. Let's say you had $1,000 in the bank which gives you 10% interest rate. In that case, that $1,000 will turn into $1,100 in just 1 year. And next year, that $1,100 will turn into $1,210, as the banks will pay you 10% interest on the $1,100 that you earned the last year. And in 25 years, that $1,000 will turn into $10,834.71. And that, my friend, is the magic of compound interest. Even Albert Einstein once mentioned compound interest as the 8th wonder of the world. He also said, he who understands it, earns it, and he who doesn't, pays it. That being said, there isn't a bank that pays you 10% interest on your savings. That's really high. On an average, banks would pay you 0.01% interest on the cash in your savings account in US. And in that case, you will still be losing money as inflation is around 2 to 3%. But there are definitely ways that can make you 10 to 15% per year on your money. And that's where investment comes in. There are quite a few ways you can invest your money, but the ones which are really common are real estate, stocks, ETFs, bonds, and mutual funds. For example, you can buy a house for $300,000 and rent it for $2,500 per month, which is $30,000 per year. And in over 10 years, you will be paid $300,000 in rent, which was your initial investment. And after that, you will continue to earn $2,500 income from the rent every single month. But besides that, real estate is a good investment as values of the house tend to go up in long term. And the house you bought for $300,000 15 years ago can be around $500,000 today. And this will generate a capital gain of $200,000 for your $300,000 house. Well, it's definitely not as easy as it looks. In order to buy a house worth $300,000, you will need a good chunk of money towards down payment. And that is if you're not able to just pay everything in cash, which I don't think people who are watching my video have. Also, over the last year, the housing market has been so competitive. The houses are being sold 5 to 10% of their listed price. So good luck with your offer getting accepted. But what if I tell you there is an easier way to earn consistent money? And that is through stocks. So basically, when you buy a stock, you hold a part ownership in that company that you have bought shares in. There are few ways you can earn consistent income through stocks. And one of them is dividends. When company makes money, they have couple of options of what they can do with these profits. Number one, they can take that money they have made over the course of a year and they can reinvest back into the business to make new products. For example, when Apple makes money, they reinvest a lot back into the business to make the next iPhone, iPad, or Mac. Option two is companies can do share buybacks, where they just end up owning more of the company because they decrease the number of shares in circulation in the open market. And option 3 is actually paying out cash payments or dividends on an annual, quarterly, and monthly basis. And that's why dividends can be a good way for us as a shareholder to make consistent income literally by doing nothing, but by just owning the stock of that company. But moving on to the second way of making consistent income in stocks is just owning it for long term. For example, if you would have bought 10 shares of Amazon in 2012, that would have cost you $1,700. And today, the value of those 10 shares would be $30,500. That's almost 16 times your initial investment. That being said, who really knows which is the next Amazon, Facebook, or Google? Well, the truth is, no one really knows. And people who tell you otherwise, just turn your back and run the opposite way. It's nearly impossible to find a company whose stock will 10x in the next few years. And you can end up losing a lot of money in trying to pick these stocks, so it's really risky. And please do your own due diligence before investing your hard-earned money in anything. Alright, so rather than taking risk of losing everything and trying to pick a stock which will 10x your money, you should consider investing in an ETF. ETF or exchange traded funds are basket of assets such as stocks or bonds which can be traded throughout the day, just like stocks. You can use ETFs to gain exposure to different asset classes in order to make sure that we are not too exposed to one particular area of the economy. Investing in an index fund or ETF has many benefits, such as low cost, low hassle, and diversification of your investments. These three things combine to create a smart investment strategy that is less risky than most of the other options for growing your money. All you need to do is buy one of these funds rather than try to select individual investments by yourself. Well, there are many different types of ETFs, but the ones that I really like are index ETFs. Index ETFs are exchange traded funds that seek to replicate and track a benchmark index like S&P 500 as closely as possible. The S&P 500 is a stock market index that measures the performance of about 500 top companies in the US. For example, the top 10 holdings in the S&P 500 are Apple, Microsoft, Amazon, Google, Facebook, Tesla, Nvidia, Berkshire Hathaway, and JP Morgan. And the collection of stocks that make up S&P 500 is designed to represent the overall health of US economy. So basically, when you invest $100 in S&P 500 index ETF, your $100 investment is split in those 500 different companies, and you bet on the US economy, which has definitely outperformed in the last 50 years. So here are three of my favorite total stock market ETFs. VOO, Vanguard S&P 500 ETF, VTI, Vanguard Total Stock Market ETF, VEA, Vanguard FTSE Developed Market ETF. This is not a financial advice. Please do your own research before investing in these ETFs. And if you want to learn what are the things that you should consider before buying an ETF, you can check out my video here that I recently uploaded. Alright, that takes me to the last part of the video on how you should invest in stock market. There was a really good market analysis done by Jeremy Schneider, aka Personal Finance Club on Instagram, which actually said that there are three types of people in the stock market. Tiffany, Brittany, and Sarah, who saved $200 per month to be invested in S&P 500 index fund. Tiffany had the world's worst timing and dumped her savings right before the market crash. And then there was Brittany, who was best in timing the market and bought when the market was at the lowest point during the crash. And then there was Sarah, who invested $200 consistently every single month. Each saved and invested over the last 41 years from 1979 to 2020. What do you think who made the most amount of money? Even with Tiffany's terrible timing, Tiffany was able to turn her $99,000 investment to $773,357. And that was all because she did hold the stocks for the next 41 years. And next was Brittany, and with her perfect timing, she was able to turn her initial investment to $1,123,573. Wow, that's amazing, right? Well, wait for this one. Sarah, who consistently invested $200 every single month, was able to turn her initial investment to $1,620,707. So as you can see, the study clearly shows rather than trying to time the market, you should consistently invest for long term rather than hoping for a short term return. Even one of the greatest investor, Ken Fisher, says that time in the market always beats timing the market. With that said, guys, hope I did provide you some value today. And if I did, please drop a like on this video and subscribe to my channel. And if you want to learn more about personal finance in general, you can click on this playlist here, and see you in the next one.